Half of it should be
Yeah.
At least,
maybe
maybe
set
20 million.
aside to
That 33
anticipate that
includes
potential.
20
risk.
million would be the fiscal 19 ballpark-ish.
But you don't know for sure.
We don't know for
because
sure.
it's
That's, I'm
even
just,
there.
yeah,
We don't know for
big
sure,
if,
and
but-
also, we don't do a consensus forecast on all
On
the
the parts.
components.
On the-
So we agreed with the total. So we had to model corporate a couple different ways. We had to think, well, what if none of that money was really repatriation, just estimated payments?
Right.
Okay, that gives you a whole different answer than if you say, oh no, that's this discrete thing, which we,
How much risk?
you know, feel pretty comfortable with looking at these individual companies, but we can't know for sure. And so then we model it both ways, we come up with different answers, we say, gee, what do you think chances are of that? And Jeff's model's different than mine. And so we came up with a number that we feel like is comfortable. I would say in mine, I'm a little over $20 million in of that would be repatriation related. I think you might have a
About
lower,
15,
lower
about 15.
number of carrying.
Yeah.
So
But you both have.
something, and
15%.
yeah.
Well, and this is part of what we do when we
Sure.
reconcile two independent forecasts. And we say, okay, we can reach a consensus, because in the scheme of things, when you're talking about a $102 million consensus forecast on corporate, this is not insignificant. A $5 million difference isn't that big of a difference.
Well, and the other parts of it, sometimes other parts of our total will be the same, but we would have gotten there in a different way. Well, why argue about the pieces? If we're at the total, that's good enough.
Except that there's risk associated with the pieces.
The risk associated with the
That's-
pieces, so we
that's
can
why.
convey that.
Yeah.
I mean, if you wanted a consensus
Yeah.
number on that, we could probably
Right.
do that, but it's in that order of magnitude, plus the potential that there will be clawback on stuff from fiscal 18. So if you wanted to be really conservative, you'd have a number that might be more like 30 million or 35 million. If you are
But-
comfortable sort of with
So
this.
we aren't going
But
to
it's-
engage in profligate spending, I think, is sort of the net
Yeah.
result of this
We shouldn't.
conversation.
Right, we shouldn't.
So when we build the budget,
That's right.
how much
Yes, we have.
ongoing?
And
We're
this is-
looking at 12 to 15, is that the?
Well,
But this is a lot different than, remember the last time you did a set aside, the legislature and the administration decided that because we had received some extraordinary refund requests.
Right.
But we knew what the size of those refund requests
Right.
were, so then what we were doing was saying, well, we know what taxpayers ask for, they usually ask for the moon, what are they actually gonna get?
Right.
And so, but the difference is here, we're doing this through analysis and inductive reasoning.
And it's brand new.
And it's it's a structural change,
Very
I've been
few other
going
states
through,
are doing it.
I've been reliving 1986 and 1987 experiences when Governor Cunin got mad at me because we underestimated the impact of 1986 tax reform on Vermont revenues. I don't know if anybody was around then.
I think she's over that.
But I'm not, because I all of a sudden was reliving that again in December and January.
Well, we're just laying it out here because it gives you a granular level of the risk,
But
and ultimately you have to decide how you
But
deal
again,
with it.
you're taking a conservative approach to this.
Yeah.
As well, there's some good news out there. 4,400 more people working. We have a housing bond that we passed last year that's coming into place. We're seeing the effects of that and leveraging more private assets, and that's all good news as well. It grows the grand list. There's all kinds of positive things that are happening.
Yeah.
Oh,
And as
yeah.
I'm traveling the state, I'm seeing all kinds of help wanted signs out there. So people are hiring as well.
Yeah.
I could work
No.
in Marnie's Deli.
You could, I bet.
No, the
Might hire you.
record unemployment,
looking
those
for.
really low unemployment rates reflect that. We're seeing housing prices firming up. We've had like 3% growth now in Vermont relative to the peak. It is very different in the Burlington MSA versus the rest of the state. There's a chart on that. It shows that kind of widening gap. But we tend to look at economic metrics in aggregate form. So we say, what's gross domestic
Right.
product, what's the total, what's total income. Some of the problems come in a distributional way. So we look at unemployment and we say, well, why isn't there more wage pressure? What's happening with that? Well, all that income doesn't necessarily have to be distributed among the average worker. There's a chart on page 6 that shows wage growth, and in both nominal terms, so the nominal wage growth had been this red line been kicking around 2%. And as you would expect, as unemployment drops, there's going to be pressure for higher wages, and it starts ticking up, and it's getting closer to 3% in some of the recent data. The last one's 2.7% up. But when you adjust that for inflation, you get the line that's below that. And this is year-over-year percent change. And you even have a period here where the two lines cross because there was deflation. So you actually had, real wages going above the nominal on a percent change basis. But virtually all of this increase that's occurred here from 2 to 3%, we're up here at 2.7%, because inflation's been going up, it's been wiping out the real wage gains, and the last number in June was actually a little bit negative. So it's, the benefits of the strong economy are not necessarily being distributed equally. It has yet to really percolate down to a lot of average workers and be as widespread as we might like it to be. I think that's an important distinction in understanding. Yeah, the aggregate metrics are looking great, but there are still issues with the economy that have to do with it.
You know our job description. As economists, it's our occupational responsibility to worry for you even in the best of times.
And we appreciate that.
Yes, and the other thing is that I have a chart on page 15 of mine, which is the survey of the Wall Street Journal of economists, and less than 1 in 5 think we're going to be in a downturn within a year. So it's still very low. It's the highest it's been since the 2016 election. It's up a couple of ticks, a couple of percentage points, but I think a lot of that has to do with the uncertainty in the economist's view of what's happening with trade policy, or potentially happening with trade policy.
Another thing,
Which has mostly been rhetorical, as opposed to having real impacts right now.
yeah, but another thing, and we both have this chart in the
Yep.
mine's on page 12.
Oh, the yield curve?
Yeah, and you've probably heard about this with a yield curve, which is one of the best leading indicators of recession, and it's not inverted right now, but you can see how it's heading down, and when it dips below that red line that's on that chart, every single time that's happened, within about a year, there's been a recession.
Mine's on page 18.
So that's a pretty good leading indicator when it's hit every single recession. Now, it's not there, but you can see the direction, and I think that's why the Wall Street Journal poll of economists, you get a little bit of an upbeat, even though 12 months from now, it would have to be negative now to say in 12 months it's going to be a recession, because you have a lag.
Yeah.
But if that kept going down, you could have a situation, say, this time next year it might be negative, then in another year it might actually be in recession. So it's not there, but there's some things like that when you're at a cyclical peak, we're looking for where are the imbalances, what could tip it into recession, how long is it going to last? It's not like there's anything imminent, but that's a concern.
Yeah, I mean, it looked like in 12, it started heading down that
Absolutely.
way, and then all of a sudden it went the other
We
way.
get false signals every
Yeah.
once in a while.
So,
Yeah, that's right,
Yeah.
it bounced back
Yeah,
up, but it didn't go below zero.
Right, but
Right.
it could, we
It
don't
could do
know,
that.
it could bounce right back up.
That's right, that's right. That's
And
right.
there-
So
and there is
there's
some-
something to watch.
There is some financial discussion right now that
Yeah.
says that long-term rates, I mean, everybody knows why the yield curve is important, right? Because it's an indicator of credit availability. Banks source their money short at lower rates and lend their money long when the rates are higher. So when the yield curve inverts, the longer-term rates come down and reduces the margin, and when it inverts, it means what they can charge is less than what they can source. So they don't provide the credit, and so the economy stops usually within a year. Okay. Right now, there are some people that are arguing a little bit against the yield curve. I don't necessarily subscribe to it, but there is a school of thought that says because of the Federal Reserve's quantitative easing-based participation increase in bond markets and bought a lot of long-term bonds, that long-term bond rate is artificially low. So the yield curve isn't actually that close to inverting because of that distortion, and the Fed is, of course, normalizing its balance sheet, and there's been a lot of hand-wringing over them going from $4.5 trillion on their balance sheet to 3.5 trillion on their balance sheet. So, you know, it's not to say that we shouldn't be concerned about the yield curve and how it's narrowing and what that might indicate for credit policy out there. It's just that each time we go through this, the circumstances are different now than they were in the late 80s or in the mid 70s when we looked at that. Sorry about your glasses. And so we just need to be careful about the way we interpret events. And in the near term, it looks like we've got a pretty good open field for the economy. But that doesn't mean that we're not without issues that we have to deal with and we have to think about, because, you know, economic upturns don't die of old age, they die for reasons. And we have to be careful about what the reasons are, but fact of the matter is, we're gonna soon be the longest upturn ever. And so we haven't repealed the fundamental laws of business cycle, so we will have a downturn at some point in time. We just have to be careful about anticipating and not be overly alarmist about it happening.
Yeah, so there was mention made of cigarette tax
Yes.
changes, and on page 16, there's a blurb about that. But typically, there is a decay rate in the volume of cigarettes sold with stable prices. So when manufacturers aren't raising prices aggressively and there's not a new tax or tax increase, there's usually a decay of around 3% or so on cigarette volumes. And this has picked up in the last couple of years, but the last year in particular, with no tax increase, there was an 8.5% decline in volume. And what seems to be new and different in the market has to do with e-cigarettes, particularly one manufacturer, Juul Labs, which has a phenomenally successful product that now controls about half of the market share. In 3 years, they've taken almost 50% of the market share of e-cigarettes, and has some technological differences, but a big cool factor as well. So it seems to have cut into sales of traditional cigarettes, and is the basis of our downgrading. And
People aren't necessarily smoking less, they're just smoking something different.
they're getting their nicotine in a different way.
And non-tax.
Talk about
And
an
non-tax.
insidious lifetime tax on somebody, you know, because if you don't.
Especially kids.
Yeah, no, it's all kids, because if you don't get somebody before the age of 25, you don't
You
have
don't
a
get 'em.
chance, you don't
Right.
get them. And this is targeted towards that age group and has been very successful. So though the spillover, now there are studies done at Dartmouth, just as a group that just did a study that says that there's pretty good transition rates from people that start on e-cigarettes that ultimately consume regular cigarettes, but until that happens with this cohort, we won't see that increase in cigarette sales. So for the time being, it's less volume than we had expected before and less revenue from that tax source.
And we only missed the forecast because tobacco products came in where we thought it would be by about 1% between the cigarette and tobacco products. But the things that were explaining the reason why we missed were concerning, and that's why the additional concern and the decay rates.
Well, there's a lot more if anybody has questions.
There's some good news in terms of our vices. I mean, alcohol sales are up as well. Our craft breweries are doing well.
Yeah.
Our lottery revenues are
Lotteries
up.
are up.
Liquor and beverage have been two of our most accurate forecasts.
That's true. Those are easy.
Probably the most stable.
Do we have a formal motion to read?
We do.
Somewhere here. Otherwise,
It's a,
I would move that we accept the consensus revenue forecast as it's been presented. I think that there are two things that come with it, one of which is being cautious what we do in the budget adjustment as it would relate to this upgrade, and how much is one time and how we want to proceed with it based on some of your testimony. And the other was the interplay with the budget that we passed, and that was how we would end 18 and what we would have in 19 to address tax refunds. So the money that we'd set aside in in the budget could flow toward buying down some of our teachers' retirement obligations. So I see those two pieces as connected to having the forecast and actually having the good news that we have today.
That we did come in over
Mhm.
the 10 million.
Yeah, oh,
Well over that.
Well over that.
And we'll certainly know a lot more by the next meeting. I mean, we'll know how the revenues are doing and maybe have more of a handle on the repatriation and so forth.
Yes.
Yeah.
So that was a motion? I'll
Yes,
second it.
An expanded.
I don't know if I seconded all of it.
Any further discussion? All those in favor, signify by saying aye.
Aye.
All those opposed? Ayes have it, motion carries. Thank you very much.